2022 has been a painful year with negative returns across all asset classes. The technology-heavy NASDAQ has seen the greatest declines, down more than 30% through the third quarter. All other equity asset classes are down more than 20%, solidly in bear market territory. Even bonds, which have traditionally benefited in times of stress as a safe haven asset, are down significantly. In fact, this is one of the worst bond markets we have seen in about 40 years. Looking into the sectors of the U.S. benchmark, the S&P 500, energy has been the best performing sector, up over 30% since the start of the year. The energy sector has done well as oil prices have increased, alongside a general pickup in post-pandemic travel and activity. The Russian invasion of Ukraine earlier this year also caused oil prices to rise sharply. Every other sector this year has seen negative returns, with the growth-oriented sectors performing the worst. Communications services and technology stocks are both down more than 30%. Defensive sectors such as utilities, consumer staples, and healthcare have fared better. This year's bear market has caused a significant decline in the valuation of the S&P 500. The forward price-to-earnings ratio has dropped from over 20 times to 15.2 times, below the 25-year average level of 16 times. We look at historical bear markets to try and get a sense of how much equities have declined in past cycles. The average peak-to-trough return of the bear markets that have occurred since World War II is 34%. The three most recent bear markets were very unique: the pandemic in 2020, the great financial crisis, in which systemic over-leverage led to a deep recession, and the bursting of the dot-com bubble, which was further compounded by 9/11. The current bear market is driven by the Federal Reserve's monetary tightening policies, and at this point, it does not appear that a broader financial crisis is brewing. Although U.S. consumers have felt the pinch of inflation, overall household balance sheets are in good shape. Debt levels remain manageable, with total payments totaling less than 10% of total disposable income. The Federal Reserve is focused on bringing down inflation, which is at the highest level since the 1980s. The headline inflation number has trended lower since the summer, but core inflation, which excludes the volatile food and energy categories, recently ticked higher. One of the reasons that core inflation is so strong is that the largest component, shelter, recently experienced the largest increase since the 1990s. This measure of shelter prices is called owner's equivalent rent, which is a semi-annually collected survey-based measure where homeowners are asked what they believe their home would rent for. This measure tends to lag market data, such as the Case-Shiller Home Index and the Zillow Observed Rent Index. The hot post-pandemic housing market has begun to roll over, largely because mortgage rates have risen dramatically. The 30-year rate has more than doubled since the start of the year, from below 3% to about 7%. Total non-farm payrolls, which measures the number of jobs in the U.S., have recovered back to pre-pandemic levels, but the number of job openings surged to nearly 12 million, far higher than the 7 million openings seen before the onset of the pandemic. Earlier this year, there were 2 jobs available for every 1 job seeker. The latest data has indicated some softening, as job openings declined by 1 million in August. In an effort to attract scarce workers in this tight labor market, employers have increased pay in the past few years, causing average hourly earnings growth to increase. However, this growth has begun to plateau in recent months. After rising from the depths of the pandemic, commodity prices, including crude oil, appear to have peaked. The Federal Reserve has increased its benchmark target rate to a range of 3 to 3.25%, with 2 more 0.75% increases expected between now and year-end. The Fed has also pledged to remain data-dependent and could adjust its monetary tightening process as it parses inflation data collected each month. Although the Fed was late to start increasing rates, this rate hike cycle is one of the most aggressive that we have seen in recent history. While inflation is high and sticky, there are signs that it may have peaked. We've maintained short-duration bond portfolios and pivoted equity portfolios to more value-oriented names with high dividend yields and low valuations.